Hello and welcome to this Mutual Fund Corner special. Today we're going to talk all about the hotly discussed quant style of investing. We're going to take you through what it really is, how their investment strategy is shaped, and also we will chat with the management, the MD and CEO, to tell you what are the big themes that they are betting on for the years to come. So let's invite our guest on the show today. We have Sandeep Tandon, MD and CEO of Quant Mutual Fund, joining us right now. Sandeep, thanks a lot for joining us and for taking out the time to speak with us. I will get to, all of the sectors that you like, where you see opportunity. But first off, for the sake of our viewers, if you could just take us through what really is the quant style of investing.
See, Pavitra, when you talk about quant mutual fund, we follow a risk mitigation strategy, which we have built through our VLRT framework. When I say in the industry, people typically talks about certain returns, certain track record, certain experience when you raise money or when you try to look for opportunity. But the way we define quant mutual fund investment principle is very different. We say we are in the business of risk management and returns are byproducts. The entire thesis of our framework, which we have built, revolves around risk mitigation. So if you understand and manage the risk in a superior manner, returns can be generated. This is the way how these thesis of VLRT framework has been built. We call it risk mitigation framework, where we give only 1/3 weighted on the valuation analytics. Then we give 2/3 weightage on the macro, which is 1/3 is about liquidity analytics and 1/3 is about risk appetite. So as a combination, it works far superior. So it's a better, well-diversified approach. So we are not just focusing on one stream. Let's take example of COVID 2020 when it unfolded. Now, market corrected significantly. Rather, on 23rd March, we hit the lower circuit. But if you could have asked me that day, what has changed? Anything has changed fundamentally? Okay, the answer was nothing has changed. Okay, the event which got triggered. But if I break these answers into a different manner, and if I look at this way from the VLRT framework perspective, then what we spotted very interesting. By the end of March 2020, the risk appetite for global equities, including India and US, collapsed. It was multi-year slow. Fundamental, nothing has changed, but risk appetite, which is derived from macro data, which is a reflection of your confidence or sentiments, if I have to say, or your conviction level, was the extremely rather multi-decade slow. Okay. What was another thing very interesting was that around that time, courtesy COVID, and all central banks were working in tandem, and hence global liquidity at that point in time was one of the highest ever. Okay. So this is the background. Fundamentally, ask me what has changed from the valuation multiple or valuation analytics perspective. Nothing got changed, but risk appetite lowest and liquidity highest. So that was the perfect background to rebuild your exposure when market collapse. So that's the way when we talk about VLRT frameworks, we are able to identify these inflection points in the market. Now I'll give you another interesting example. Come September 2021, okay, when whole market was euphoric, okay? And if you recollect, all the new age companies, technology companies were at lifetime high, okay, or all-time high sort of thing. And what we noticed that time as compared to March 2020, that money flow towards global equity was multi-decades high, and there was a euphoria. And if you dissect the euphoria, it was confined to new age technology companies, not in value. And simultaneously, if you look at liquidity right from February 2021 till September 2021 was shrinking from different market or different asset classes. And similarly, risk appetite also started declining. That's the way we spotted. That is the phase we said that easy phase of bull run is over, okay, which started in September or April 2020. It peaked out. So we said that globally easy phase of bull run is over in September 2021. And we shifted from growth to value. So we spotted important inflection points in the market, and that's the edge of VLRT framework. If you ask me, we were one of the mutual fund who has exited technology stock completely at that point in time, and 6 months later you realize they have all corrected 30 to 50%. And simultaneously we went long on the banking names, and we built extraordinary position in ITC, because at the time we spotted ITC were at different levels, okay, in terms of inflection points. It was in the deep neglected territory. Everything was in favor. So instead of, we sold technology and shifted towards ITC and banking. And that thesis played out very well in the beginning 2022. That's the way this VLRT framework gives you edge over normal valuation analytics model, which people look at. So we don't get just carried away only on the valuation, because pure valuation multiple has, or valuation data has multiple challenges. It gives you great entry points, but does not give you great exit points. It's very important to combine the macro data along with the company specific data that really help in mitigation the risk. And so it becomes a very nice top-down approach from a global perspective to India macro. Then we come to the VLRT framework to India specific. Then we try to understand whether we are in risk on or risk off environment. In the risk on environment, which was the case, let's say from April 2020 till September 2021, we played on front foot, try to generate extraordinary alpha in the risk on environment. September 2022 till 21 till September 2022 was a risk off environment. In risk of environment, whole idea is just to protect the capital. So that's the way how inflection points can be identified with the help of VLRT framework, and it really helps us in the risk mitigation.
Yeah. By the way, this VLRT that Sandeep is talking about, for our viewers, it's valuation, liquidity, risk appetite, as well as timing. Sandeep, I want to talk about the risk element a little bit more, because like you said, it's a lot about what you do when you are hit by something like that. There's, of course, a known risk, which all of us are aware of when we get into the equity markets. But then there's an unknown risk that can hit you, something like COVID, for example, like you mentioned. And it becomes a lot about, what you do in that situation, how you react to that risk. You also, across Quant, you have a very high portfolio churn. We've spoken about this before. Do you think that is the best way to sort of handle this kind of risk, not get emotionally attached to your stocks, and just look at quick churning every time, an event like this hits you?
So, Pavitra, when we talk about purely from mathematical perspective in the market, we talk about systematic and unsystematic risk. And as you rightly pointed out, we take the risk concept to the next level and we try to quantify between known risk versus unknown risk. That gives you far better perspective. So when we talk about at Quant, that known risk, okay, the known risk can be mathematically quantified. Let's say example, right from 2020, we talked about how 2020 till 2030 will be very challenging environment. In 2019, in our book, we have written how inflation will come back, and we will see extraordinary commodity prices, agri prices. How you do it? So we work on a concept of market employed data, like how market participant reads about from the yield curve, whether it's flat or inverted, and then try to see how the interest rates are environment. So this is what exactly is the concept of market employed data, what market is implied. So you can reverse calculate up to certain extent, and you can say how the scenarios is emerging. This is the way how we defined our predictive analytics model. In today's context, a lot of people talk about machine learning or AI. When we started our career, there was no such concept. So we built the concept of predictive analytics, where I'm trying to connect the dots and try to see what is coming. That is what is known as known risk. Okay. For many people, forecasting events like inflation or commodity prices movement or crude prices movement, sharp spike, can also be considered as an unknown risk, because they look at more from a just specific data, they don't get answer. When we look at much larger perspective and connect the dots through predictive analytic models, we can actually quantify. So for many people, it could be unknown risk, but those are known risks. But any events which unfolds, okay. Recently, we have seen a corporate action event happen, and you talk about, let's say, budget, okay, came out and the life insurance company was penalized. Best of the name was corrected between 10 to 20%. And many such events we have seen in last my 30 years of career. I have seen multiple times these events have unfolded. Now, unknown risk is very difficult to quantify. It is practically not possible to quantify unknown risk. But what is very important, Pavitra, to see how you handle the portfolio from a risk perspective post the event is unfolded. Okay. The challenge which I have seen in my 30 years of career, and it has happened with me also, we all get emotionally attached with a stock when stock corrected for 30%, 40%, 20%. Okay. Then we realize, okay, this is not the time to sell. Because you are looking at purely from emotional perspective, some of the people says now it is in a deep value zone. I will double my position. I will triple my position. This is a great opportunity. When we talk about at Quant Mutual Fund about dynamic style of money management, we don't have any emotions in dealing when it comes to the risk. Okay. So let's take example when this event recently, which you're talking about, unfolded. What we spotted something interesting is that even the larger perspective by January end, we spotted that even the risk appetite for India has also declined, which was expanding from June 2022, India was the first country where risk appetite data was started increasing. Now, come January 2023, what we spot, obviously, these lot of data which we look at from monthly basis or some data from quarterly. These are not, these are macro data, so cannot be quantified on daily basis. Okay, what we spotted, the risk appetite for India, both on absolute and relative basis, have declined very sharply. Okay, where emerging market risk appetite is rising. China, we have been vocal right from November 2022, we say China has reached the most neglected territory because risk appetite hit the lifetime lows. And it was lower than even COVID levels also started inching up. So now it is a very unique situation where India, which has been an outlier in the market in entire 2022, suddenly risk appetite decline, which means outflow has started. And that's the way we have seen a lot of hot money or the ETF money has started moving out from India to other emerging market countries. So that's one important data point we also saw. And we also saw that how liquidity tightening, which we talked about, the tightening cycle globally has actually peaked out in November 2022, but India is still not peaked out. The tightening continues. So with that background, it is a very important message how you rebalance your portfolio, both from the safety perspective and the risk perspective. And then we can get into the company specific risk also, what change, how the risk appetite for particular group or particular sector or particular stock has changed, how the liquidity has declined and the changes which we talked about, both from inclusion or exclusion of indices. So multiple data points. When you start looking at is anything got changed from the fundamentals point of view in these companies? Answer is no. None of the insurance company or where the event unfolded, anything got changed overnight. But how the risk appetite and the perception got changed, how the liquidity got reduced significantly. So when we talk about our VLRT framework, we are able to capitalize these data points well, and then we are able to take decision. That's very important. We talk about the events can unfold, but it's up to us how we manage the risk post the unknown risk is unfolded.
No,
That
of
is
course.
the
I mean,
key
that is
for
what will help
dynamic
you
style.
safeguard your portfolio as well. We completely take that point. Sandeep, two quick questions. We're running out of time, so I want to, try to get both of these in because I have read your note. Since you were mentioning the entire Adani episode that did play out, I think a lot of people were concerned because Quant did have a significant exposure to Adani. So your thoughts on that? Were you able to trim your entire exposure? I do have to ask you that question. And my next question then is, now from here, what do you see as the key themes or sectors that you've identified which you think will do well?
See, generally we don't comment on from a regulatory perspective on the individual stocks or holding, but a lot of things which is there in fact sheets in public domain we can talk about. So we had Adani Enterprise exposure as a index play which we capitalized, and we exited somewhere mid-October 2022. So that virtually at the peak of the cycle of that stock, we exited that stock, and then we were left with the Port and Ambuja. And Ambuja, we have been seller in last many months. So we have pruned down our exposure by 40 odd percent or 30, 40 odd percent. We pruned down. Yes, Port, we had exposure in that thing as well, a good long-term play. So these are the two names we had in our portfolio. When data points change, both from the macro perspective and the group specific, how the liquidity data decline, we took appropriate step and rebalance our portfolio. That is the beauty, Pavitra, is about dynamic style of money management that can leads to higher churn. But I don't think that churning is considered bad the way we manage money. Ultimate objective is how I can balance my risk, how quick I can rebalance my portfolio if environment has changed. Okay. So a lot of people have been taught these things, churning is actually bad. Rather, I will saying if I'm able to rebalance my portfolio based on the risk on and risk of environment is a great strategy, a great tool to be used, and we optimize that.
No, and we've seen time and again that strategy has worked. Even last year, I think this is a piece I put out towards the end of the year when a lot of the larger fund managers found it very difficult to beat even the benchmark. Quant, of course, did very well. So, we definitely have that data. One final question, Sandeep, because, you look at all of this data, what do you think are the sectors or pockets that you expect will do well, say, in the next 1 year? I do know that you like metals and manufacturing, so tell us why. And also, IT has been doing very well. Do you think that's something that will sustain?
So when we talked about in November 2021 how China's risk appetite and liquidity cycle has bottomed out and they have infused more than 3 trillions of RMB in the system. So one option is that as an investor or trader, you can participate directly in the Chinese. That's one option. Since we didn't participate through that route and we didn't want to participate from a longer term perspective, we have chosen to play through metals route. So we spotted that opportunity that metals could be a surprise element of 2023, purely based on the changing macro data on Chinese market. So that's a one data point you can play. Then India, we have been saying that manufacturing is the thesis for the current decade. Value stock is the thesis for the current decade, and even for the half century, that's the view we have on the manufacturing space. So anything which revolves around manufacturing, whether you talk about auto ancillary stocks, whether you talk about the metals and the basic material stocks, we talk about infra stocks in general, a power sector in general, which are supportive of infra or play with the manufacturing thesis. These are the spaces which we like. See, if you really recollect, like as I said, that September 2021, 21, we exited the technology stock. But yes, we have added some of the names in our portfolio in last few months because we spotted some of the names have hit the most neglected zone, which we generally look at. So we have added. But if you ask me whether overall sector has reached the most neglected zone, which we generally look at, then answer is big no, they have not reached. But yes, some of the stock specific, we have seen that move. So we are trying to capitalize. When you look at the fact sheets of the last month, you will get some perspective that we have also added. So maybe today we have a 5-7% exposure or 8% exposure, depending on the scheme in the technology sector also. But wherever we think these are the names which actually have been qualified through a VLRT framework, we have built our exposure. But from a longer term perspective, I think bottom is still not in place.
All right, bottom is still not in place for IT, but opportunities are definitely emerging. On that note, Sandeep, we are going to wind down on this special. Thank you very much for joining us, taking us through your entire investment approach, and really helping us with where you see some of these sectors is well headed in the years to come. But on that note, it's a wrap on this special.